Good afternoon, everyone, and welcome to our post-election market outlook. My name is Tom Essaye, and I am editor of the Sevens Report. And obviously, today's been a pretty surprising and eventful day in the markets. So what I want to do is just take a few minutes of your time this afternoon to go over what we think the surprise election result means for the markets broadly, and then for specific sectors and asset classes as well, because we're pretty sure that whether you're an advisor or an investor, you have a lot of questions about what's going on right now in markets. We're going to try and cover that as best as we can. Whenever we do these webinars, we try and get some specific goals that we want to accomplish. Today, we want everyone who listens to be able to quickly and confidently answer these two questions. What does the election mean for the markets, and who are the winners and losers? Because if you're an advisor, those are questions that you're going to be asked by clients or prospects, and having an immediate, thoughtful answer is important. And if you're an investor, you've got money at risk in the market. So again, you need to know the answers to those questions for yourself. So with that in mind, in the next few minutes, we're going to cover what the election means for the broad markets, and again, which sectors stand to win or lose. But we're going to go beyond that. At the Sevens Report, we cover every single day equities, commodities, currencies, bonds, and economic data, because we want to give everybody a 360-degree view. So we're also going to include our outlook for asset classes, bonds, currencies, and gold, because they are going to trade off of this historic election result. Talking about the election specifically, it met our ugly scenario, and that's not a political opinion. We produce, for events like this, for paid subscribers, we produce a preview, and in the preview we usually do a good, bad, and ugly based on the expected market reaction. The Trump surprise victory was our ugly scenario, and if you need to see why, just look at futures last night when they were down 100. We said specifically that stocks initially would elicit a sell first, ask questions later response because of uncertainty, and that ended up being completely true. Now, that has changed throughout the day, and we're going to cover that next. But we did see a pretty nasty response last night for those of us who were watching it live when the election results became somewhat known. Importantly, we do not view the Trump victory as a bearish game changer for stocks. And we use the term bearish game changer in our report to paid subscribers. And then what we mean by that is this something that would make me materially reduce equity exposure? And the answer is no. We do not view a Trump victory as something that wants to make me materially reduce equity exposure in portfolios. And that's an important distinction to make. So if the election result was such a surprise and there's so much more uncertainty out there, why are stocks rallying? And that's a very good question. We have seen a historic rebound from the lows overnight. I mean, if you're like me, you were sitting there watching this thing live and you looked and the Dow was down 700 points and the S&P 500 futures were down 100 points, and you were thinking, oh boy, this is going to be an adventure here tomorrow morning. But since then, we've totally recovered, and as of recently, the S&P 500 was up nearly 20 points. You're talking about a huge swing. So what happened? Well, first, reason one, it has to do with sort of trading and positioning. A lot of people are comparing this result to the Brexit decision. And what markets did there is they collapsed on the initial news and they rallied back and kept going. A lot of investors thought that if Trump shocked the world, that something similar would happen. So people bought the dip. And as the market rallied, it brought in more buyers, frankly, people not wanting to miss that run. So a lot of this has to do with just trading, with expecting a similar Brexit type trading scenario and not wanting to miss that rally. If we do see a similar Brexit type reaction, we don't think we're going to see that, and we'll explain why shortly. The other reason stocks are rallying is because very few people expected the Republicans to take both the Congress and the presidency. So you have a fully unified government under one party. Traditionally, a fully unified Republican government has been very pro-business, good for the economy, good for the markets, because there are usually tax cuts and increased fiscal spending associated with the fully Republican government. So you're seeing people look past the initial result with Trump and say, hey, normally it brings good times here in the market, so maybe we want to buy stocks and get ahead of it. Again, I think that's a bit premature, and I'll explain why here in a minute. Uh, so given all that, and given the impressive price action that we've seen today in the market, is Trump a bullish game changer? And our answer is no, not yet. And there are a couple different reasons for that. Most of which have to do with the significant uncertainties that need to be addressed between now and Election Day. And I'm going to go over a couple of them. We're going to cover these more fully in the paid edition of the report, but I do want to mention them here. First of all, Trump has said that he will label China a currency manipulator. If he actually does that, that's going to be a problem for markets because nobody knows how the Chinese are going to react, whether or not that's the beginning of some sort of a trade war, whether they do nothing, whether they just sit there and take it, nobody knows. So that is one of the first questions that markets are going to want to have answered here when he takes the presidency in January. Second, the Fed. It is no secret that Donald Trump has not been particularly pleased with the way the Fed has been managed under Janet Yellen. He thinks interest rates are artificially too low. So that leads a bunch of questions. Will Yellen resign? Trump can't remove her. A little known fact is that the president can only remove the head of the Fed for cause. He can't just remove her because he doesn't like her. So if she wants to stay, she will stay. But if she does stay, does that create some sort of a public tension between the two of them? Or does she feel pressure to raise interest rates more quickly now? If Trump thinks that interest rates are too low, and in fairness, a lot of people do agree with him. But anyways, that drama with the Fed, as if we haven't had enough Fed obsession here over the last couple of years, there's the potential that this could turn into some sort of a soap opera. So that's another uncertainty that we need to get some clarity on. And then finally, trade. Obviously, Trump has made a big deal about our trade deals, and he's not very pleased with them. The president has a lot of power to change trade deals on his own. Not total power, but he has a lot of leeway. So the question is, what is he going to do with a lot of these trade deals, and what does that mean for our economy and our specific businesses? Now, I want to be clear about something. All of these issues, and there are more of them, again, we're going to cover more of them in our report to paid subscribers tomorrow. All of these issues could be resolved very favorably. They don't have to be negatives. But the point is, we're not going to know for a while. And these are pretty big deals. So we think that the uncertainty, once we get past sort of the madness of the post-election market gyrations, these sort of issues, these unknowns, will become a bit of a headwind on stocks. That said, we'll go a bit further into the different asset classes and our outlook for each of them. So the S&P 500, we're neutral post-election. We believe we're still stuck in this 2150 to 2200 range based on valuation. You'll notice something, probably the most important thing going on today. It has nothing to do with stocks. It has everything to do with the 10-year Treasury yield, which is now well through 2%. And I'm going to talk about why in a second. Rising yields with valuations where they are in stocks is a problem because yields aren't rising today because of growth. I'll tell you that much. That's going to be a headwind. That creates a valuation ceiling. If you've been reading our research, even the free excerpts for a while, we've been talking about this valuation ceiling at 2,200 in the S&P 500. We think that hardens out of this result. We think it maybe even comes down if the dollar keeps rising and if bond yields keep going up. So we are neutral on stocks post this decision, at least near term here in between now and year end. Bonds negative. You're seeing it today. I think the 30-year Treasury is down like 2% or something, which is a huge move for the 30-year Treasury. The reason bonds are down is because traditionally, Republican-style government, which is lower taxes and increased spending, is negative fiscally. Okay, if you're taking in less and spending more, that's not the best thing fiscally. Treasuries tend to reflect that by declining, especially when we think about where they are right now on a valuation basis. So you're seeing treasuries sell off based on that. It's the equal and opposite of what's happening with stocks. But in today's world, that decline in bonds and rally in yields, that's going to become an issue for stocks and beyond, again, the sort of confusion / euphoria / despair, depending on what side you were on of the post-election in market. So bonds negative. This is a negative event, and that's a big deal. Dollar index neutral. It's up a bit. It was sort of all over the map overnight. Now it's up a bit. You know, the slow grind towards 100 should generally resume, but we don't see the Trump victory as sort of a significantly positive catalyst for the dollar. The major force behind the dollar is the simple fact that the Fed is deciding how quickly it needs to raise rates, while every other major central bank in the world is either very much on hold or deciding how much it needs to cut rates. And that wide gap between respective policies will continue to support the dollar. We continue to view it sort of in the mid to high 90s, and dollar index seems to be a pretty happy place for it for a while going forward. And then gold, this is positive. Gold traded up big last night. It's down a bit now, but beyond, again, the short-term stuff, this is positive. Uncertainty and inflation are positive things for gold, and we are going to get more of them in the coming months and into early 2017. More uncertainty and more inflation, and gold does well in that environment. We continue to say anywhere in the mid 1200s, which is sort of where it is now, mid to high 1200s is a longer term buying opportunity. Going a bit more granular, looking at some sector winners, there are definitely some infrastructure stocks, defense stocks, coal, energy, pharma, biotech, and banks. We covered these extensively in the paid edition of the report. We have given specific ETFs that we think will outperform if Trump won, and they are big time outperforming today, and they likely will continue to do so. There are definitely winners out of a Trump victory based on his expected policies, and these are them, the sectors listed there. Sector losers, hospitals, because we're almost certainly going to see a material change, if not an outright repeal of the Affordable Care Act. That is bad for hospitals. They were sort of the big winners out of that entire law. And then also alternative energy sectors are and stocks. We probably see reduced funding to some of those projects, and they are two sector losers. Again, we have specific ETFs that we have provided for paid subscribers, and they are all doing very, very well today. Bottom line, sort of as we step back and we say, okay, what is the 10,000 foot takeaway from this shock election? Markets are sort of euphoric right now, but we don't see this as a materially bullish near-term issue. I mean, is this going to cause a year-end rally by itself? No, I don't think so. There's too much uncertainty. And as we get past the euphoria of today in markets, a lot of very hard questions need to be answered. So we don't see this as a materially bullish catalyst. Now, can stocks rally into year-end? Sure, but I think they need something else. And that rise in the 10-year bond yield has got to slow down. And we cannot have it rising this fast and expect a rally in stocks. That just won't work. So we can rally into year end, but this by itself isn't going to do it. And it's not a reason for me to run out and significantly increase my exposure to stocks, hoping to catch a rally into year end. However, we do think there will be select tactical opportunities, and we discussed some of them in the previous slide. And so tomorrow in the paid edition of the report, we're going to put out our post-election portfolio of tactical ETFs that we think can outperform into year end. We've done a pretty good job of finding some tactical positions here in the back half of the year that have done very well. And we're going to continue to do that because we are convinced if we think the broad market is sort of stuck at 2150 to 2200 in the S&P, the way to outperform is by getting tactical. And you're seeing that today. Cyclical sectors are massively outperforming. Yield proxy sectors are massively underperforming. So being tactical is the way you're going to generate outperformance into year end. We don't think we're on the cusp of a major rising tide for stocks. I mean, it would be great if we are, but the facts don't imply that that's what we're seeing. So we continue to believe you have to be tactical. We're very focused on doing that for our paid subscribers. Finally, thank you for listening. That's about it. We don't like to take too much time. We like to keep these to 15 minutes because everybody's busy, including us. If you would like to get our post-election portfolio, you can receive a 2-week trial of the Sevens report. go to sevensreport.com. You can just sign up for it there. It's a daily macro report, comes at 7 a.m. every morning. We cover equities, bonds, commodities, currencies. We give you the talking points to start your day right, to make sure you're on top of markets and are in position to answer any questions clients or anybody else may ask you about markets. Again, it's totally free to sign up for the free 2-week trial. We welcome you to do so. And thank you very much for listening today. Again, this is Tom Essaye of the Sevens Report. Thank you and have a great day.